Hello and welcome to the Auto Remarketing Podcast. I'm your host, Joe Overby, Senior Editor of Auto Remarketing. And my guest today is Ned Hennessy of Surmount, which is a full service commercial real estate platform. His team runs the real estate capital markets and advisory programs for several of the top franchise and independent dealers across the country. Surmount is in a unique spot in that they're the only full service real estate advisory practice exclusively focused on dealerships. So excited to talk to Ned here, and we're going to talk to him about his work with auto dealers and some related real estate trends he's seeing. But first, Ned, thanks for joining. Good to see you.
Yeah, thank you, Joe. It's a pleasure to be on here, and I appreciate you having me.
Of course. Well, let's start at the top. What is some of the specific work that you guys are doing with dealers, and what sort of real estate matters do you advise them on?
Yeah, so I can give you sort of a background on our firm and then how we integrate, sort of the firm platform, into our specific business. So our firm, started as in and pro as a brokerage firm for net lease assets. Dealerships kind of fall in that greater category of net lease. Glenn Kanofsky started our firm, the practice that, eventually became our firm 25 years ago, a little over 25 years ago. And, since then we've grown tremendously and over time added, business lines that, really met the needs that of our clients. So we've got, brokerage arm that does, a lot of sale leaseback work specific to a lot of different categories. Today we're going to be talking or asset classes. We're going to be talking about dealerships and investment sales in that space as well. We've got a lease advisory arm that used to be STNL that advises clients when they've already when they've signed a lease or done a sale leaseback and they want to structure, restructure, terminate, buy back, or implement our buy and recast system. A development, management and construction finance and sort of everything that encompasses the development process arm. And all of those had separate business lines up until about 2 months ago. We rolled everything under the brand Surmount. So, I don't have to explain as much, explain that whole sort of timeline as much anymore in that process. But now we're just Surmount and we're, full service in the sense that, Surmount offers all of those things versus all of them being sort of individually offered. They were offered, in the same way, but it's they've been rolled up into a single holdco. So, flashing forward, from when the firm started, we've done, now about 40 billion in transactional work, which is, I think the most, for a net lease brokerage. We've done, several billion. I guess one thing I forgot to mention is we brought on debt. We brought on a debt team. So that's kind of like the fourth line effectively. We brought on a debt team about the same time we launched Surmount. So we've got debt, and sale leaseback, capital, lease advisory, and then development management. And that's kind of the full service aspect of our firm. And we, offer all those services to, specifically through me and my team, to our dealership clients. And so, we've done a lot of work recently, reviewing leases of deals done, without our advisory, either to, the dealer that, was basically selling the business, wanted to keep the real estate, or, the buyer didn't want to, didn't or couldn't buy the real estate, or, groups that have done sale leasebacks in the past, and are in a situation that, they would like some advice on and potentially some help. And we do a lot of sale leaseback work specific to, franchise automotive, independent. We cover actually, the commercial truck and equipment space as well. But, most of our work is, in the, automotive space. So that's sort of the high level overview of our firm and what we do.
And does some of your, work kind of looking at the overall umbrella of auto dealer real estate, does some of that get into or get involved with the M&A and buy sell process? I mean, that's been a huge, it seems every day, we're reporting on dealership sales. Do you guys get involved with that as well?
Yeah, absolutely. So there's sort of three or four instances in which we really, get involved, and that's, sale leaseback or, facilitating the debt, for the real estate or, some component of sale leaseback debt and lease advisory, because that can happen too. So obviously there's instance one, a dealer owns, a bunch of real estate. They want, us to analyze that real estate, provide, an underwriting package and say, hey, like this is where this trades in the market and where we can go facilitate this deal. We do that all the time. I think that's a really good way just for any dealer really that is, 5% or, 95% committed to, hey, I want to go, seek this kind of capital out. It's really hard to have a conversation or understand, what we're talking, what the value is, what the process looks like, any of that without, formal evaluation. We do that on a complimentary basis for all clients, potential clients. It's I highly, recommend that to everyone. Um, so you've got owned real estate, then you've got, development real estate. So we do a lot of, forward funding, underwriting, and then facilitating capital for forward funding and development projects, right? So if someone says, hey, like, I've got this real expensive development project, I need to do it. But it's just going to be so capital intensive and it's going to really limit my, liquidity and ability to have capital for extended growth after that. We'll go, do 100% forward funding. We'll find that in the market at the most aggressive rate. The third is through M&A. And so we have really good relationships with the M&A market. That is, the brokers and bankers that are, facilitating those deals. We get a lot of referrals from that network. We're also very in tune with, the accounting firms and law firms, in that transactional space that kind of take care of dealers and are in tune with the needs of their clients and then, we organically have a lot of relationships with dealers that are, involved in M&A. I mean, we're doing, several of those transactions right now. So the answer to your question that I answered, long-winded is yes. A lot of it is, I think, catalyzed by M&A, right? Sale leasebacks, capital typically is sought after for growth purposes. So M&A is sort of the catalyst for a lot of this. And a lot of times it's either, hey, I want to go sell leaseback my own real estate as a sort of war chest of cash to then go grow with. And that process, you can really control. You can do it, in a much more you're not as it's not as time intensive, right? There's not a timeline that has already started. You have the capital, and then you can go do what you want with it. The M&A, the simultaneous M&A process, we do often. So, like, if a dealer or an M&A broker brings us a dealer and says, so and so is buying, this dealership or this pack of dealerships, the real estate's worth this. We usually, the relationship now is usually, hey, can try to bring us in as early as you can, right? I mean, obviously there's not like a high percentage chance that you're going to do a deal until you've, gotten through to the accepted LOI stage. And even then there's a lot of moving pieces that can, shake a deal up. But we try to get brought in, if a dealer or, one of those other affiliates is thinking about, it's like, look, we're probably going to do this deal, or maybe not this except LOI stage, but it's highly likely. We said, bring us in. We'll put together, an underwriting package of the real estate, with the financials, and we can even go look at the sites very quickly, in about a week. And from there, you've got sort of you've level set, right? Where we can buy it from the dealer at X. We can sell lease back it for Y. It's typically, 140, 50% of that value. So you get to not only not have to come in with the capital for the real estate, but receive a cash injection that you can then use as, part of your, goodwill payment or, extend the liquidity to go then do this process again. and it just maximizes your amount of total capital to grow. Um, and we like to be very meticulous with this, and order due dil recommend that a lot of our dealers order due diligence up front, because it allows us to control the process. If you allow a buyer or investor to then control the due diligence process, we can't fix things. If things come up during real estate due diligence, or formal due diligence of the company, whatever. And you then have to wait on someone else's timeline, right? You want everything to kind of be on your timeline. You want to control that. So we, try to handle all of that up front. And we close, simultaneous to the closing date of the regional transaction. We sign, an agreement, and you basically get, a trickle down funding of, you receive your cash from the sale leaseback sale, and it then goes and funds um, uh, the price that the original seller wanted simultaneously, and it's done pretty smoothly. We've executed on hundreds of these deals for as a firm, for everyone from large public companies to private equity firms to large private operators. So ton of experience doing this. I would say it's an art. You have to meet a moving target, and you have to be really, really diligent and sort of concise in your process. All while keeping a high level of confidentiality, right? Because it's highly confidential, right? It's an M&A deal. There's a lot of information from the seller and the buyer, financially, that has to be kept close to chest. And no one wants an M&A deal to get out, right, to their dealers, to their dealership employees, to the rest of the market. Even though a lot of these deals are kind of the people that are in the know, but the people that are not in the know want everyone involved usually wants it to be kept that way. So yeah, we do a lot of simultaneous M&A work, and again, that's a lot of the catalyst for sale leasebacks. I think it's either simultaneous to, or just in cash to then grow. It's a reason money's being spent. It's cycling money, and the interest in aggregating more is usually tied to M&A.
Yeah. Well, you mentioned the term sale leaseback, and then you mentioned the
Yep.
fund that you guys have seen kind of significant growth in sale leaseback. So for the uninitiated like myself, what does a sale leaseback entail for a dealer, and what are some of the
Yeah.
advantages it might have for a dealer doing it?
Yeah, look, I think I will be the first to say the sale leaseback is an excellent tool. It is not for everybody, but it can be really really used to the benefit of a lot of businesses in general, right? You've got Lockheed Martin, Walgreens, Amazon, Chick-fil-A, huge public operators that utilize this, right? That and I think all the publics used it at one point in time, the publics in the dealership space. Lots of private dealers are utilizing this, and I think it can be really effectively used if you can nail the cap rate, right, the cost of capital. If you can really structure a proceeds deal that you get a significant premium over that appraised value. You're getting paid effectively for the cash flows that you're going to give the investor down the road. That has to be a part of the deal, and you've got to structure a good lease. And I think we'll talk about that later. Everyone wants to talk about cap rate. They always want to talk about proceeds. The lease got overlooked, I think, tremendously for the last 10 or 15 years, and there was expectations towards things that just we've reviewed and are like, I don't know how these guys agreed to this. And I think the reason is they didn't know otherwise, right? There's elements that are just very restrictive and that we don't see in any other sort of vertical that we cover or historically with dealership deals and currently with dealership deals we've facilitated. So, back to, just sale leaseback at its core. I mean, a sale leaseback is effectively a transaction in which someone that owns real estate or that has the opportunity to buy or develop real estate can uh, basically go out and seek funding from investors where they basically trade equity or ownership of that real estate in exchange for cash in the sense of forward funding. It would just be funded as it is being built. If it's owned, it's you're basically receiving cash for your equity in your own real estate. And if it's simultaneous to M&A, it's going to be typically, the amount that that original seller wants is paid off, and there's typically again an excess of 20 to 50% over that you would then receive. Um, it is contingent upon a long-term lease, typically 15 to 20 years. Market, there's typically rental increases on an annual basis. Market, I would say now is about 2%, just as a proxy for inflation. And this is an absolute triple net lease where the tenant, effectively controls this real estate. I mean, you effectively are leasehold owning this real estate. You no longer have your equity, you've cashed out, but you control this real estate. I mean, there's no change to how you operate these facilities or um, and a lot of times, most people, employees of these groups don't even know that, ownership's traded hands, you've cashed out. Because again, there's not going to be, some overbearing, landlord walking around your property or anything like that. It's hey, we want you to continue to do everything that you're doing exactly how you were doing it. We want a rent check, and every month, and um, you know, that's it. The relationship is, investor receives cash flow, on a, monthly basis, over 15 to 20 years. Um, Operator tenant gets, cash and that's it. There are not, that many other contingencies, to the deal. Option periods can be built into those, option periods are built into these leases, typically 5-year options, to the tune of, 4 to 10, you can build in 20 to 50 years of extra control at 5-year increments, after the initial term has, worn off. So, I mean, you sign a 20-year lease, you have 50, years of options, you effectively control it for 70 years incrementally, if you so choose, after doing a sale leaseback. So I think um, a lot of the talk sometimes is about control, and I think a sale leaseback, if you sign a good lease, you absolutely will control that real estate, and have a good amount of flexibility while being able to cash out the lowest cap rate, and which results in the highest proceeds amount, and hopefully a very healthy delta to that appraised value. So that's what a sale leaseback is, and I think it's not for everyone. I will be the first to say it is not for everyone. If people are saying it is for everyone, I think that's just not right. But it can be for a lot of people, and I think you really just have to look at the nuts and bolts of it. Say, look, let's look at this. Let's look at the real estate. Let's look at your financials. Let's talk about what you want to do here. Um, what are your goals? Because there has to be a lot of thought and process to this, to then go execute on a contract that you're going to be in for 15 or 20 years. It's got to all make sense, and I think 99% of the deals that we've done as a firm in and outside the dealership space, we really look at that very closely, because we're not in the business of just you know flipping deals. It's we really want to develop long-term relationships with clients. We really want this to make sense. We want to, execute it at the highest level, and add a lot of value, right? Not just value, when the check is received from the investor, value, and comfortability after the fact, to where it's like, I feel good about doing this 5 years after, right? Or 10 years after. So that's sort of my 2 cents on that.
Sure. Yeah, and I imagine it's control without ownership essentially. And does that, I guess it needs to be, when you're doing the sale lease back to have kind of one trusted partner that you can do it with rather than, 15 cooks in the kitchen.
Yeah, so that point I think is yes and no. I think when you're running an initial process, you want to figure out who the best partner is monetarily, right? Cap
Yeah.
rate and proceeds, and who's going to give you the best lease, right? And I think when you run a competitive process like we do, you not only get the best monetary terms, but you get to really dictate and have a lot of control in dictating, what kind of lease you sign. And when a dealer or any business, for this matter, goes to a fund or goes to an investor and says, I want to do a sale leaseback, there's almost no incentive for that investor to give them, the best terms, the best cap rate, the best proceeds, and really, have any negotiating power when it comes to terms of this lease, which are going to be, there might be, 8 or 10 terms you really want to negotiate hard, and get, really on the favor of the dealer. And it's really hard to do that because you just don't have that much negotiating power. If you're a public or one of the top, 25 dealers, you do because you're just such a great, dealership tenant. But I mean, if you're not, it's hard, right? And what are you going to negotiate with, right? When you run a process, you can negotiate with the fact that you've got 9 other people lined up to give you what you want, and you can sort of use that process and that competition that's created um, to drive value, right? To drive, what you want as leverage. And so I think that's really important. And but in terms of, one versus many landlords, I think, growing with one and picking a horse is great in the beginning. I think that when you're doing deals, you should always utilize a process, because I think, someone may have had a, big allocation requirement to begin with, and the next time you want to do a deal, they may not be as competitive. Um, and things change in the market. Things change within these funds, in terms of appetite and exposure to different asset classes, and just macro changes in the market, or changes. They may have gotten acquired and things change. So I think that on the initial deal, you find a really good horse. If it makes sense to keep growing with them, great. Run a process, because you still have to have that leverage. It's still, you still want to put some pressure on them to continue to give you the best deals. Um, and then I think when you become saturated at a point with that landlord, it's a really good idea to try to find some others. Because again, it's all about leverage, right? If you put all your real estate in with a single landlord, they've got a lot of leverage over you, just, objectively. And so it's nice to break that up between, 3 to 5 different landlords, spread it out, because then you can create some competition between your landlords, right? Without, and sort of negate the process even. But that's, I think, what it is. I think it's all just, you have to look at each situation very specifically, but I think, it's all about leverage, right? It's all about being able to negotiate to the best ability. And I think, it's run a process every time. Don't let your landlord base get too saturated, and diversify that after the fact. But those are all things, that we handle for our clients, and stress to our clients. And um, I think we've managed, extremely well for the groups that we work with.
And you guys have reviewed, dozens of deals for, clients who want to restructure, reduce rental obligations, or even terminate their existing leases. So, kind of as a two-parter, what might be some reasons dealer groups are looking to shift things around? And then what advice might you have for dealers who are entering a lease, um, things to avoid that might later cause them to need to restructure and that sort of thing?
Yeah, I mean, we've reviewed a ton of leases. I mean, we have a huge arm of our business is reviewing leases for public and private dealer groups, and looking at inefficiencies or efficiencies that can be created within their rental amounts, and the basically the relationship between rent and performance across their portfolio. Are there sites that need to be terminated, or rent reductions? Are there sites that we can extend? Are there sites that we could potentially buy back from the landlord at X, call it 10 million and, restructure a long-term lease and sell it back into the market at 15 million or 14 million, create, a capital event, create, a long-term lease that, we're able to write in that process. Um, or there's sites, you just want to buy back, in general because you don't want to lease that anymore. Um, and we do all of that, terminations, buybacks, restructuring. We try to be, really involved, in clients' initial structuring of these leases because it's so important. Whether you're, doing a sell leaseback or whether you're a dealer that is, going to lease real estate, or let's say a seller that is going to lease real estate to the group coming in and buying it as sort of an annuity, right? I say this a lot because, the dealers that want to, hold on to that real estate as kind of an annuity, they've got to structure a lease that's market, right? Because it loses a ton of fungibility if it's not market, in terms of term and absolute, triple net nature and increases. And, is the rent, set right? And then, what are the terms in the actual lease agreement? Because if the dealer wants to hold that as an annuity, they're going to sell it at some point and they have to be able to that lease and that contract has to be able to be sold in the market to the best of its ability. And we try to I try to emphasize that a lot. That's sort of an instance where a lot of people aren't thinking. They're just, yeah, we'll agree to this, and it's very casual under this buy sell agreement. We just want to get rid of it, get past this. This guy's going to pay me rent. He might not. And you want your lease to be, written correctly. You also want it to be as marketable as it can be when you decide to sell it. So that's another instance. But um, so on the flip side of your question, we've reviewed a ton of leases. From groups that have done deals, without us, which, there wasn't a ton of advisory in the real estate dealership space. There still isn't. But there was really none for the first, last, going back, 10 years ago, there really wasn't any. And so, the few funds that were doing most of the sale leasebacks in the space, kind of got away with whatever they wanted. And I think, some of the things that we've seen in these leases are covenants. Covenants are a debt, term. It's kind of like the landlord having its cake and eating it too. In that sense, they get equity and they get covenants, and I think that's overreaching. We've never done a deal with covenants in the dealership space and any of the other spaces that we represent. That's just thrown out immediately. That's just not market. We've seen assignment fees. If a dealer wants to assign a lease to somebody, they've got to pay a point or a half point on the sale price, which is just crazy. They shouldn't have to do that. That's never been a part of a deal that we've done. Letters of credit, equal to 6 to 12 months of rent. If a dealer goes below a certain credit rating, which is similar, I would say, to a covenant, and the monetary sort of punishment for the covenants too. It's 6 to 12 months of rent. Basically being paid up front, which is a huge amount a lot of times, and so that's especially if it's across a portfolio. So those are some big ones. We've seen, really strict assignment and change of control provisions. So, basically like pigeonholing a dealer to not be able to sell their dealership, after they've done a sale leaseback. They can only sell it to like this small group of, revenue or EBITDA metrics. We've really opened that up in every deal that we've done to give our clients the maximum amount of flexibility when assigning, these leases. There's definitely some other ones too that are a little bit more nuanced, but I've got a list of 10 or 12, that we try to really understand and know and say what are we seeing here so that we can advise, that this, or achieve, more optimal terms. And so those are the biggest ones: covenants, assignment, change of control being pretty bad. Um, Assignment fees. We've seen a lot of personal guarantees, which should not be in there. So those are a lot of the things I think that, just generally we see and try to either mitigate, completely or optimize, and we have, and we just wouldn't tell a dealer to sign a deal, right? If these were in there, because they're just going to be, it's going to create a bad situation down the road. We'll just tell you, don't do this. So
Well, speaking of things dealers should be on the lookout for. Last question before I let you go. What's on your radar in terms of macroeconomic factors, especially as they apply to property, that dealers should be watching here in the second half of the year?
yeah, I mean, you just had the big, beautiful bill come out, and that is definitely, I think, the most relevant to the property itself. You've got 100% bonus depreciation coming back, and I think most dealerships, you see anywhere from 15 to like 30% of the total improvement value qualifying for that 100% bonus, which is big deal. You see it, 15 to 30% may not seem like a lot, but if you've got 15 or 20 million dollars worth of improvements, 15 to 30% of that 15 or 20 million dollars that you can write off 100% year one is a big deal. I am not a tax accountant, so this is not tax advice, I'll be the first to say, but talk to your tax accountant, figure out how this big beautiful bill um, affects your real estate and effectively your ability to write off, and appreciate on your income, which makes your income go up. It's a good thing. And so that's, I think, the biggest, on the real estate. I think as it relates to the real estate market, and really dealerships, performance and buzz as a whole is the tariff situation. I think the tariffs have sort of created a lot of uncertainty for everyone in the space. I mean, you talk to most, people in the M&A space, you look at what's going on, transactions are slowing, profits are normalizing downward. We don't really know where that's going to be. Is it going to rebound? What effect is this going to have? How long is it going to last? And then you've got, a lot of sellers holding on to, pricing expectations that are just, through the roof, and we're just not there anymore. It doesn't, the new environment does not seem to reflect that we will be in that same position that we were, 10 or 3, 4, 5 years ago, anytime soon, if ever. And so you've got real uncertainty in the market because of this, and it's not just tariff driven, but it's largely tariff driven at this moment in time. And I think that's it's driven down transactions, it's driven down profits, and so everyone's kind of figuring out, what do we do, right? Where are we? What do we do? And a lot of the buyers, I think, are just waiting to see where things normalize, and they're absolutely not going to pay these prices that were achievable, right? Even 8 to 12 months ago. So that's kind of driving money movement in the space. Again, sale leasebacks a lot of time correlate with that M&A. When that slows, I think sale leasebacks have slowed down. But I mean, candidly, we haven't really slowed down. We're continuing to ramp up and build and grow and figure out who needs what, and try to offer the best advice and execute to the best ability for the dealer. But that I think is it. I think you see rates, right? Rates are going to be a topic of discussion. Inflation just went, just toggled up. We're probably not going to see rates cut anytime soon. Certainly not, I don't think, until May of next year. I think Fed Chair Powell and Trump are in a little bit of a contest here, a standoff, and I don't think he's going to do anything. They're not going to do anything either one of them wants the other one to do, unfortunately. And the added inflation being up is not, it makes it very hard for the Fed to cut rates. I mean, it fundamentally does not make sense for them to cut rates. So that's another thing, right? Rates. Everybody wants rates to go down. When rates go down, consumers, can more cost effectively buy cars. Dealers can more cost effectively floor plan their inventory and get debt and capital. It usually correlates to lower cap rates too, right? In our market, where cost of capital for funds and investors going down means cap rates go down. It's not a one-to-one relationship, but when cap rates go down, it's obviously an increased amount typically you get on your property, or multiple on the rent. And so That's a good thing too. But I think tariffs rates, are the biggest talk right now. And then the big beautiful bill, of course.
Well, Ned, we'll leave it there for today. I really appreciate you coming on. This is an area, specific area in a dealer's business that we don't, get to talk a whole lot about, and really is an interesting piece that kind of it's good to have more coverage on it. So it's great talking with you, and thank you for joining the show.
Yeah, no, I really appreciate it. And hopefully we can do more of these in the future. And we're always happy to, offer what insights we have into sort of the real estate aspect of this business.
Absolutely. Well, that'll do it for today. For today's episode of the Auto Remarketing Podcast. Thanks for listening.